Hey traders, a very warm welcome to you. So what is the VIX? You might have heard of the VIX, but you're not quite sure what it is, how it's constructed, what does it mean from a trading perspective. Let me kind of explain what it's all about. So the VIX is the volatility component of the implied volatility of S&P 500 options. In other words, it's over a 30-day period. It's basically saying how volatile do people expect the market to be over the next 30 days. And that actual figure is calculated from put and call options in the S&P 500, taking a kind of average of multiple differences of those and saying, okay, what's the premium people are paying when you strip out the value of the option, the intrinsic value of the option, the time to decay and all that kind of stuff, time to expiry, sorry, and all that kind of stuff. You know, what's the remaining volatility component of the option? You know, how are people pricing volatility? In other words, what are they expecting? Now, what kind of things affect the price? Well, the VIX is really people's perception of how much insurance they need. If you can imagine a portfolio manager with several billion under management, if he thinks the S&P 500 may well drop heavily or may well be volatile, and generally speaking, guys, you know, volatility is linear with downside movement. You know, upside volatility doesn't normally happen. There are certain events like we had, binary events like Brexit and presidential elections where, you know, there's volatility potential for both ways, but under normal market conditions, volatility doesn't happen to the upside. Upside volatility isn't really relevant. So in other words, people are just protecting themselves against downside volatility. They just don't want the market to be completely collapsing through the floor, and so they will go out to the options exchange and they will be buying put options on the S&P 500, or they'll be buying a mixture of spreads to kind of give themselves a protection to the downside, so buying puts or selling bits and pieces and different combinations of options to create, you know, a whole trade that basically gives them an insurance and says, okay, well, if the S&P 500 falls by X amount, I will make lots of money from my options, I'll lose money on my portfolio, but it's a kind of hedge. So really, the VIX is the pulse on people's expectancy of volatility, and you'll get spikes in VIX when, you know, some news perhaps comes out that, you know, world leaders about to launch a nuclear weapon, for example. So it's a bit drastic, or, you know, war potentially could break out, or something, there's a bit of a crisis going on in the banking system, or something like that. You know, something where, you know, there's going to be something kicking off, and you can look, if we can go back on our VIX and we can see all the spikes and you can correspond them with various news items. Generally speaking, you know, VIX will spike for a bit, and if it's a prolonged crisis, obviously it's going to carry on spiking for a long time. It's going to stay high for a long time. But, you know, if it's just temporary, you know, if you look at this 2008, you know, it spikes for a long time before falling back. But if it's just temporary, you get these temporary spikes that kind of come, and when the thing blows over, people aren't interested in buying insurance anymore, and they're not interested in paying up for the options. It's just a supply demand thing, guys. More people that want insurance, the higher the premium is going to be. And so that's ultimately how we get this VIX spike. So how do we use it in trading? Well, really we can look at it and say how people are perceiving things. When VIX is very low, there's complacency out there. They're expecting the market just to chug up and up and up and up, or just sit and do nothing. They're not expecting any kind of risk. And when VIX starts to spike, people are a little bit more alert. They're buying the insurance premiums. Does the VIX continue to hold at highs? Does it pull back a little bit? Generally, you get a kind of burst in one direction and then it pulls back a bit, and then it's subsequent to see what happens. Is it just a one-off kind of thing? Are they rebuying premium? Are they rebuying protection for the next month, the next quarter, whatever it may be? So it's a good kind of barometer to give you an idea of what's going to happen, because ultimately, when VIX is high, there's a perception of volatility, but there may also be volatility as well. So if you're trading indices, you want to be reducing your position size, increasing your stops to take into the account the increased volatility that is there, or potentially could be there in the market, so you're not getting caught out and stuff. If you don't have access to the VIX futures, you can get them on FinViz and stuff. But another way of checking it is to use the VXX ETF, which is a VIX tracker. It kind of got a little bit of a decay built into it, but on a short-term basis you can see, so you can look at kind of how it compares to prior couple of days or prior couple of weeks or whatever, and see if it's spiked dramatically or not, and then know that potentially there's volatility coming in. Now you could then do some research and say, well, is that because we have something expected coming out that I haven't seen, or is it just general sentiment based on some macro information or news flow that's coming out that needs to be aware of? But whatever the reason, it's always prudent to keep an eye on the VIX, and even if you're not trading indices directly, you're trading currencies, just because it's a general gauge of, listen, the guys in the know are in the know as in on the pulse of news flow, should I say. No one really knows what's going to happen in the market, but the guys who are kind of in tune with the news flow and what's going on are cautious enough to pay for insurance. And if those guys are cautious enough to pay for insurance, as retail traders, we should probably take notice of that and maybe integrate that. Whether that's a prediction of a future crash or not, who knows, but being aware that something could happen, because ultimately, guys, markets only move on people making an action. So if they then decide that they want to sell stuff, they've got insurance, and they want to kind of reduce the portfolio, and multiple people do that, you might see a bit of a down move. If they don't, it's just insurance, then you're not going to see that. But it always pays to kind of keep an eye on the VIX, keep an eye on what people are feeling out there in the land of money management, what they're concerned about, what sort of protection they're buying, are they paying a premium for it, and maybe gives a gauge of what might happen in the future with the markets. All right, guys, take care. Good trading. I'll see you soon. Bye-bye.